If you live in Canada and you've heard of the FHSA, but you're still not really sure how it totally works, you're not alone. Some people think it's just another RRSP. Others might think it's a TFSA with a house label. And a lot of people haven't even opened one yet, even though they absolutely should. Here's the short version. The First Home Savings Account, the FHSA, is the only account in Canada that gives you three things all at once. An RRSP-style tax deduction going in, a TFSA-style tax withdrawal coming out for a qualifying first home, and a built-in Plan B where unused money can become retirement savings. In this video, we're going to walk through the FHSA from beginner to advanced. And in the episode, we'll cover what the FHSA is and why it is different from a TFSA and an RRSP, eligibility, contribution limits, and timelines, how the tax side works, deductions, growth, and withdrawals, how the FHSA interacts with RRSPs and the homebuyers plan, how parents and adult children can use FHSAs together for intergenerational planning, key estate and beneficiary considerations, including successor holder versus beneficiary designations, a few practical scenarios and mistakes you should avoid, and finally, how to actually use the FHSA in your own plan. So here's a quick intro about myself. I'm Yudhvir Kabuli, a chartered professional accountant and a chartered financial analyst with over half a decade of Big Four Canadian corporate experience. Please take a moment to read the disclaimer on your screen. Alright, let's now unpack the FHSA. At its core, the FHSA is this: an account that gives you a tax deduction when you contribute, tax-sheltered growth while it stays invested, and tax-free withdrawals if you use it for a qualifying first home. So it blends the best of two worlds. The RRSP benefit, contributions are deductible against your income today, and the TFSA benefit, qualifying withdrawals of both contributions and growth for your first home are not taxed. And if you don't actually end up buying a home, what happens then? Well, you can just transfer the FHSA balance to your RRSP or RRIF tax-free without needing additional RRSP room, and then just treat it as retirement money instead. So the FHSA is basically a first home account plus a built-in backdoor to RRSP if life changes. So let's talk about who can open one. To open an FHSA, you generally must be a Canadian resident for tax purposes, be 18 or older, and be a first-time homebuyer under CRA's definition. First-time homebuyer here means you do not live in a home you owned or that your spouse or partner owned in the current year or in the previous 4 calendar years. So if you moved out of a place that you owned, you need a full 4 calendar year gap of not living in another owned home before you would qualify again. You also have to be a Canadian resident when you contribute to an FHSA and when you make a qualifying withdrawal. If you become a non-resident, you can usually keep the account, but you generally cannot make a qualifying home withdrawal while you're a non-resident. Any withdrawal in that non-residency period is normally treated as taxable, not tax-free for a home. Now, let's take a look at the contribution limits. FHSA limits are up to $8,000 per year and up to $40,000 over the lifetime of a person. Here's a really important detail that a lot of people miss. The FHSA room only starts once you actually open an FHSA. So if you wait until, say, 2029 to open it, you wouldn't magically get room for 2026, 2027, and 2028. The clock starts ticking when you open. If you do not use the full $8,000 in a year, you can carry forward up to $8,000 of unused room to a future year. That means the most you can ever contribute in a single calendar year is $16,000, $8,000 of the current year room plus up to $8,000 of carry forward from the prior years. The CRA tracks your FHSA room across all FHSAs in your name, just like with the TFSA. And there's also a time limit. An FHSA can't stay open forever. You must close your FHSA by the earliest of 15 years after you open your first FHSA, the end of the year you turn 71, or the end of the year after you make your first qualifying withdrawal for a home. By that time, you will either use it for a qualifying home or transfer the balance to an RRSP or RRIF, and the third option is to withdraw it as taxable income. There are 3 big steps: contribution, growth, and withdrawal. First, contributions, just like an RRSP. When you contribute to an FHSA, you get a tax deduction today, which can reduce either your tax payable or increase your refund. You can choose to deduct the contribution in the year you make it or carry the deduction forward and claim it later when you know you'll be in a higher marginal tax rate. That timing flexibility can actually be a really powerful tax planning tool if you know your income is going to be ramping up. Second, growth. That is tax sheltered. Inside the FHSA, interest, dividends, and capital gains all grow tax sheltered as long as they stay inside the account. The CRA won't issue you any T5 slips. No capital gains reporting while all of that is happening inside the FHSA. And third, the withdrawals can be of two types. One, qualified withdrawals for a first home, and two, non-qualified withdrawals. Qualified withdrawals are where the magic happens. Your contributions plus your investment growth all come out tax-free as long as CRA's first-time homebuyer rules and the qualifying home conditions are all met. At a high level, for a withdrawal to be qualifying, you generally need to be a first-time homebuyer under CRA's definition, be a Canadian resident at the time of the withdrawal, have a written agreement to buy or build a qualifying home in Canada, have that purchase or build closed before October 1 of the year after your withdrawal, and intend to occupy that home as your principal residence within about a year of buying or building it. Non-qualified withdrawals are basically treated like income. You do not get the special tax-free treatment, and your financial institution may actually withhold tax at source. And this is key. Unlike a TFSA, if you make a non-qualifying FHSA withdrawal, you do not get that contribution room back ever. The room is gone permanently. So you want to be very clear whether you are using FHSA funds for a qualifying first home or for something else. You also want to avoid over-contributing, and you might ask why. If you put in more than your available FHSA room, the excess amount is generally hit with a 1% per month penalty tax on the highest excess balance for each month until you fix it by withdrawing the extra or until new room opens up and absorbs the excess. So if you are contributing at multiple institutions, please keep good records and always double check your CRA My Account before you push more money in. Now let's talk about RRSP and FHSA transfers. There are really two directions here. We already talked about FHSA to RRSP or RRIF. That's your plan B if you end up never buying a home. But you can also move money from an RRSP into an FHSA. If you do a direct transfer from your RRSP to your FHSA, the transfer uses FHSA contribution room and counts towards your $8,000 per year and $40,000 time limits. You do not get a new tax deduction for that amount because you already got a deduction when the money initially went in to your RRSP. The benefit is this: once that RRSP money is sitting inside the FHSA, it can now potentially come out tax-free for a qualifying first home instead of being fully taxable RRSP income later. So, RRSP to FHSA transfers don't actually create extra deductions, but they can convert some of your RRSP into a future tax-free home withdrawal bucket, as long as you respect all of the other FHSA rules. Now, let's talk about combining the FHSA with the RRSP homebuyers plan. This is one of the most powerful parts for first-time homebuyers. You can combine the FHSA with the RRSP's HBP. High level, the FHSA gives you up to $40,000 lifetime per person with tax-free first home withdrawals. The RRSP with the homebuyers plan currently allows you to withdraw up to $60,000 per person from your RRSP with a 15-year repayment schedule. If both you and your partner fully use your FHSA and your HBP, you're taking home a very meaningful compiled pool for a down payment with some serious tax advantages, and we're talking $200,000. The exact mix depends on your income and timelines and saving capacities, but the key idea is this: the FHSA does not replace the HBP. Used properly, it actually stacks on top of it. Now, let's get into the part that I'm most excited about. The FHSA is actually a clean intergenerational planning tool as well. This is especially relevant if you're a high-income parent with adult children who haven't bought their first home yet. First, the FHSA room is actually per person. If you have adult children, 18 or older, who are also Canadian residents and qualify as first-time homebuyers per CRA's definition, each of them can open their own individual FHSA with their own $8,000 per year and the $40,000 lifetime limit. This isn't shared with you as their parent. It is your children's separate account. Now here's where the strategy comes into play. As a parent, you can gift your adult child cash and they can contribute that cash to their FHSA. What happens, you might think? They get the tax deduction. The funds grow tax sheltered inside their FHSA, and if they buy a qualifying first home, the withdrawals of contributions and growth are tax-free for them. You've used your after-tax dollars to give your child a serious boost towards their down payment, and you've also given them a tax break and tax-sheltered compounding. That is good parenting. Now, the attribution question. In regular non-registered accounts, if you give money to a spouse or minor child, the income from that money might be attributed back to you and taxed in your hands at the higher marginal tax rate. Inside an FHSA, however, similar to a TFSA, the attribution concept doesn't work the same way. The account is registered and non-taxed. The income and gains inside the FHSA do not have to be reported on your tax returns, and there is no attribution of FHSA income back to you as a parent who initially provided your child as a cash. So once the gift is made and contributed to the FHSA, the growth is effectively off of your personal tax radar forever. From a family's perspective, this strategy does three big things. First, it moves taxable investment income away from our top bracket parents. If you kept the same money in your own non-registered investments, the interest, dividends would have been taxed at higher marginal rates. By shifting funds into your child's FHSA, the future growth on those investments is now tax sheltered. Second, it gave your child a structured, tax-efficient path to home ownership, the much coveted Canadian dream. And with the FHSA, they get a dedicated bucket for first home savings. Contributions will lower their tax bill, the growth will be tax sheltered, and qualified withdrawals are all tax-free. You're not just helping the child with a random gift, you're plugging them into a policy-designed, tax-efficient home building structure. Third, you can also keep a plan B if their path changes. If your child ends up not buying a home, or their life takes a different direction, the FHSA won't just blow up. They can in fact transfer the FHSA balance into their RRSP or RRIF without using any additional RRSP room. So your family hasn't wasted the effort. You've turned your gift into long-term retirement savings for them at that point. Let's suppose you're in a high tax bracket as the parents. Your 24-year-old child, Alex, just started working, has never owned a home, and now has his first $8,000 of FHSA contribution room. You gift Alex $8,000, and Alex contributes that to his FHSA. Alex would get an $8,000 deduction at their marginal tax rate. If their rate is 25%, that is $2,000 in tax savings for Alex. The $8,000 is invested inside the FHSA and will continue to grow tax sheltered. If the $8,000 turns $14,000 and Alex then buys a qualifying first home in Canada, the entire $14,000 can now be withdrawn tax-free toward Alex's home down payment. If Alex never buys a home, that $14,000 can be rolled into an RRSP and become his retirement savings instead. From a family perspective, you've moved out money from your highly taxed environment into a tax-sheltered structure owned by your child with a built-in Plan A, the house, and Plan B, retirement. For families already funding RESPs, the FHSA can actually be the next logical registered account once children are 18 or older, working, and finally filing their own tax returns. Now, let's talk about something a bit more advanced. What happens to your FHSA when you unfortunately die, and how successor holders and beneficiaries work? The FHSA doesn't just stop working when you die. What happens next decides on how you set up things now, whether you name a successor holder and who you name as your beneficiaries. Most institutions will give you two separate options on the FHSA forms. Option 1, a successor holder, which can only be your spouse or a common law partner, and one or more beneficiaries, which can be a spouse, children, your estate, and so on. Let's break down what that actually means. First, the successor holder. If you name your spouse or common law partner as the successor holder, and they meet the FHSA eligibility rules, they can essentially step into your place as the FHSA holder when you die. In practice, that usually means the FHSA does not get fully taxed on your final return just because you passed away. The account value can continue in a tax-sheltered way in their hands, either as an FHSA if they still qualify, or via a rollover into their RRSP or RRIF, subject to the rules and timelines. Here's an example. Let's suppose you die with $50,000 in your FHSA. Your spouse was named as a successor holder. That $50,000 does not show up as income on your final tax return. Instead, it can move over to your spouse and then into their FHSA, RRSP, or RRIF on a tax-deferred basis. Later on, they'll pay tax only when they withdraw from their RRSP, or they may use the housing option available to them depending on their own plan at that point. For married or partnered Canadian, this is why it's so important to actually fill in the successor holder section. Please do not leave it blank, life is uncertain. Now for our beneficiaries. Separate from the successor holder, you can also name your various beneficiaries. If your spouse is not named as successor holder, but is named as a beneficiary, they may now still be able to receive the FHSA amount in a tax-preferred way, for example, by transferring it to their own RRSP within the allowed rules and timelines. That generally involves a bit more paperwork and coordination, and the exact tax result depends on how the transfer is structured. If the beneficiary is not a spouse or a partner, for example your adult child or your estate, the treatment is actually much harsher. In that case, the full fair market value of your FHSA on the date of your passing is usually included as income on your final tax return. So if you died with that same $50,000 in your FHSA and your adult child is just listed as a beneficiary, which is what typically happens, your final return would report $50,000 of FHSA income. Your estate would then pay the tax on that amount. Whatever is left after the taxes are paid is what your child would eventually receive. There are narrow, more technical situations for certain financially dependent children or carefully structured transferred into their RRSP or RRIF where deductions can offset some of the taxes. Those are very specific situations. You have to plan with a tax or estate professional. So here's the big picture takeaway for estate and family planning. If you have a spouse or common law partner, strongly consider naming them as a successor holder first, and then as a beneficiary if needed. That usually gives the cleanest path to keep your FHSA value tax sheltered in their hands, instead of triggering a large tax bill on your final return. And if you're thinking about children or their heirs, don't assume your FHSA will pass to them in a tax efficient way just because they are named your beneficiaries. In many cases, your FHSA is taxed in your final return first. A cleaner strategy is often to help them open and fund their own FHSAs while you're alive, using gifts so the growth happens in their individual names tax sheltered right from the start. That way, you keep more control while you're here, reduce tax drag on your own investments, and set up your next generation with a properly structured, tax efficient first home or retirement tool, instead of just leaving them a surprise tax bill inside of your estate. And one more advanced nuance before we wrap up with mistakes to avoid. Like TFSAs and RRSPs, the FHSA is designed for investing, not for running a day trading business. If the CRA ever views the activity in your FHSA as carrying on a business of trading securities, the income could be treated as taxable business income, even though it is happening inside a registered account. So please treat your FHSA as a long-term investment account, aligned with your home timeline, not as a casino or a get-rich-quick scheme. A few quick mistakes to avoid before we finish. Opening too late. The 15-year clock starts when you open your first FHSA, and room only starts once you've opened it. Waiting an extra 5 years to open shrinks your window of opportunity and costs you years of tax-sheltered compounding. Not investing the FHSA. Leaving everything in cash for 10 or 12 years defeats the entire purpose of having an FHSA. It is much advised that you match your investments to your home timeline and your risk tolerance. Another mistake is assuming any withdrawal is tax-free. No, only qualifying first home withdrawals get the special treatment. Other withdrawals are taxable, and that contribution room is gone forever. And over contributions can actually trigger a 1% penalty per month. Another common mistake is to ignore the FHSA when the parents want to help. That means missing actually a very clear, clean, intergenerational planning opportunity and leaving everything in the parents' taxable accounts at the highest tax rates. So let's recap. The FHSA gives you a deduction like an RRSP, tax sheltered growth, and tax-free withdrawals for a qualifying first home in Canada. Isn't that amazing? The limits are $8,000 per year, $40,000 per lifetime per person, and your room only starts once you actually open an FHSA. The maximum you can put in during any 1 year is $16,000 if you have carry-forwardable room available. It stacks with the RRSP homebuyers plan, giving you a much stronger down payment toolkit when used together. So think of your $60,000 plus the $40,000. For parents and adult children, the FHSA is clean intergenerational play. You can gift cash, your kids get the deduction and tax sheltered growth. And there's no income attribution back to you, so that's a win-win. And if they buy a home, withdrawals are all tax-free. If they don't, it can simply transfer into RRSPs without using any extra RRSP room of theirs. And at the estate level, successor holder and beneficiary designations decide whether that FHSA stays tax sheltered in a spouse's hand or becomes taxable on your final return. So please make those designations wisely while you're alive. If you found this video helpful and you want to build a Canadian money system that actually fits your life and brings you closer to the Canadian dream, hit subscribe, tap like so more Canadians see this, and turn on notifications so you don't miss our weekly videos every Saturday here at 10 a.m. Now, I'd love to hear from you. Are you planning to use an FHSA for your own first home? Or maybe are you a parent thinking about helping your kids out this way after this video? Or are you more interested in how the FHSA and RRSP homebuyers plan work together in your full down payment strategy? Whatever your question is, drop it in the comments below. I'll read them and use them to shape future videos on this channel. Once again, I'm Yudhvir Kabuli, CPA and CFA. Thanks for watching, and I'm excited to see you in the next episode of The Canadian Dream, your Canadian personal finance playbook. Until then, stay sharp and keep investing.